Hi, this is Alan Olsen. I wanted to spend a few moments with you talking about tax planning. There's a lot of things going on in the US right now in terms of trying to sort out election results, but we also have tax planning at year end. And what do we do? What do we do when we're looking at between now and the end of the year? Well, there is stark differences between the Trump plan
We will cut taxes for middle-class families
versus the Biden plan.
I'm going to eliminate the Trump tax cuts.
Depending on what side you're predicting is going to be put in place, there are some things that you need to consider now. One of the things that Biden is looking at is raising individual tax rates to 39.6%. Well, that may not be all that bad because it's just literally putting it back to where it was in 2007. So there are differences there. One is posturing for higher taxes. The other one is trying to look at how do we cut the tax structure. When we move into capital gains, this is an area that there's a lot of stark differences here. Donald Trump's plan is he's going to seek to cut the top capital gain rates by executive action to a maximum of 15%. And then he would consider indexing the capital gains for inflation, and otherwise he would extend all the other goodies that are currently in place past 2025. Joe Biden, on the other hand, is looking at getting rid of capital gain tax for individuals making over $1 million and saying all those capital gain rates of 20% or lower are going to be taxed at the top ordinary rate. And then he would also look at reforming some tax incentive areas for opportunity funds to partner with nonprofit community organizations and directing opportunity benefits reviewed by the Department of Treasury, and then introducing more transparency by the recipients of opportunity funds. So even though he's talking about a top rate of 39.6%, it's counterbalanced with if you invest in certain projects that the government identifies, there's ways that you can mitigate that tax rate. In the area of the wealth tax, right now, neither Donald Trump or Joe Biden support wealth tax going in place. Joe Biden is going to be looking at capping the itemized deductions at 28%. So it's going to go back to what the AMT rates were putting in place. And individuals earning over $400,000 are going to basically lose benefit for all of those itemized deductions. So, but the number one thing you need to realize is that you have November, December to do something, and then after December, you're gonna lose the ability to do planning for 2020. So there's major changes that you're going through. If you're planning on, as the media is reporting, Joe Biden going in,
I'm the president and you're fake news.
that means your tax rates will be going up for 2021. So the idea with whenever you see rates going up, you want to try to accelerate income into the lower tax year and defer deductions into the higher tax year. So you can sell stocks and take gains this year. This is the time to do that, to reset the basis on some of your long-term capital gains. The other thing that you can do, a lot of individuals are doing right now, is gifting the property out to charities. And that way you could do, if you have a philanthropic goal, it's better for you to, give the money to into charity, and you'll get the fair market value as a deduction on your return. Under current law, you can, if you contribute capital gain property, you can get up to 30% of your adjusted gross income on your income tax return as a deduction. If it's in cash, you can get up to 60% as a deduction, as long as the gifting is made to a public charity. There's special rules if you're giving to private foundations, which I say go consult with your tax advisor if you're in a situation making substantial contributions. So, hey, this is Alan Olsen. I want to cut it off here. We got a lot to go through, but just to give you a little overview of the difference between the Trump and the Biden plan. If you need more information, please contact your tax advisor.